Good Tuesday morning, Market Chameleons. Everyone join us for the first time. Thanks for checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man all the way from the Jersey Shore, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with disclaimer? It's up there for everyone to see.
Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your broker or call your registered investment advisor. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Thanks, D.
Yep. And let me share my screen. One sec. Here. Okay. If you guys are joining us for the first time and you have any questions, you can put those questions on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. So click on that link. It takes you over to Zoom. Once you get over to Zoom, there's a button, raise your hand. Click on that. Don't have to turn on your video camera, but we will be able to hear you live, and you could ask your question like that directly. While we're waiting for questions to queue up, I'll start out looking at the pre-market report. We'll take a look at what's trading in the pre-market hours and take a look at what's coming up on the earnings front, maybe get some insights of some of the earnings that have been released and what's coming up. Sound good, Will?
Perfect.
So this is the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 67 stocks on the percentage gainers list, 93 on the decliners. So from this perspective, we're looking like a more bearish bias at the open. I'm going to filter out this list to see what's going on in the S&P 500 stocks. So this will take out any small cap stocks, ETFs, leverage products, preferred stocks, just to focus on stocks that are part of the S&P 500. To do that, I'm going to use this filter here in ETF. I'm going to drop it down, select SPY, which is the S&P 500 ETF. And I see down here. So by doing that, I'm filtering out holdings that are in SPY. And here I'm coming down, I see 17 stocks made our percentage gainers list, 22 on the decliners. So kind of a mixed bag, a little bit more bearish bias at the opening here. One thing, sticking out right now, Walmart reported earnings yesterday, or here down 9%, which I think for Walmart, that's a pretty big move post earnings. We could take a look at that. But they were talking about it yesterday. Looked like kind of negative news, I think, for inflation. The way I interpret it is Walmart say that the cost of food, beverages has gone up to the point where their customers don't have enough money to buy other stuff like apparel, and that they would have to probably start to discount to sell off excess inventory. So I'm not sure if that, how do you interpret it? Is that more news inflationary or deflationary? Because you hear both sides, like, all of a sudden we hit a spot where now it's deflationary. The demand has gone down.
Well, I think inflationary pressures are leading to deflationary activity, right? People can't afford to buy product now.
Right. And which is, it's exactly, it's not in a good way. It's kind of like stagflation, right? What's going on is like, that's kind of what we're seeing, in my opinion, that inflationary pressures are there. They're hurting the economy to the point where we're not growing, we're not productive. So we got now slow growth, but the inflation is still there. So that's kind of how I interpret it. Like, would you say that whatever so far Walmart said would make the Fed, at least from just that perspective, make the Fed lower interest rates?
No,
Not not
I think they're going to do it another 75 basis points.
Yeah. So this Wednesday, they're going to do, looks like they're going to raise it another 75 basis points. That's the consensus. But if you look out into the future and you look at that 10-year, the yields are starting to drop.
Come in. Yeah.
So come in. So for whatever reason, whatever the market is seeing, they think that Fed's going to go in reverse and start lowering interest rates at some point, maybe next year, from an economic slowdown. So we'll see. It's right now an interesting battle. Are they going to have to keep raising it, or are they going to be lowering it back down due to a slowdown in the economy? Besides Walmart, I think in sympathy, a lot of these stocks are going down. So down the line, these retail folks, are just going down, I think, in sympathy with mall. Amazon down 4.6%, Target down 5.1%. I think some of these are online retailers. So let's take a quick peek. We'll take a look at Walmart from a perspective of the earnings move, and then I'll see what else is coming up.
Yeah, and it wasn't earnings. I think it was actually it was brought up.
Was it guidance?
I think it was guidance. Yeah.
Okay. So sorry. It was guidance. I believe that it was that they released guidance.
Our number one European chameleon pointed that out. Lawrence let us know.
Okay, right. So it's an earnings guidance, right?
Hey, D, your mic, you want to shift your mic around. It's a little underwater.
Okay. Is that better?
Not really. Maybe try something, another plug in, plug out, maybe.
Let me see. I mean, at this point, the only thing I could do is shut down my computer and come back in, but that might take
All right, perfect. Let's try that.
You want to try that?
Oh, you're good now. Whatever happened, you're good now.
Okay.
All right, perfect.
So that was guidance, and we're seeing these in sympathy go down. So let's take a look at what's coming up on the earnings front, upcoming, and then see if we could get more insights. So here, the calendar. So up here, earnings calendar. This will look at today's. So here you could change the date. Right here, it's defaulted to today, July 26th. If there are earnings coming out, this is the list of stocks. Their symbols, names, the time of day they're reporting. So over here, after the market close, on top of the list, Microsoft, Google, Visa, Coca-Cola. You could see here they reported already before market opens at 6:55 a.m. They issued a press release. That's what that means. If you click on it, you can go read it. So by clicking on it, it'll take me to that press release. And then you could read about what's going on with Coca-Cola. Let me just come back over here. We also have, the previous earnings move. This is the expected move. We don't talk about this report that much, but this is the expected move based on the option straddle in the nearest month that covers that earnings. Okay, so that's what this is coming from. Buying the call, buying the put. If you buy both, the stock has to go up or down by a big enough percentage to cover the cost of both of those options. And then once the stock reports earnings, we start to track it up to the end of the trading day. So far, Coca-Cola up 1.1% in a pre-market. You could see yesterday's straddle was anticipated to move up or down 2.9%, up 1.1% in the pre-market so far. We'll see how that does by the end of the day. Looks like McDonald's reported earnings up 0.75% pre-market. UPS reported earnings down 2.6%. So just in my head right now, as I'm looking at some of the stocks that are lower or some of the stocks that are warning, like, we're seeing like Walmart, some of these online retailers down, UPS down. I'm wondering if that's going to create pressure on stocks like Google and Meta, which rely on digital ads for the most part, right? So all these companies that we're seeing pressure on, are they going to be cutting their sales and marketing? And that will create pressure on Google, Meta, and we've seen already a couple of them warn, that are in that digital marketing space. So maybe we'll take a look at Google from a quick fundamental fair value approach. What do you think, Will? Unless you have questions, I think you're on mute, Will.
That sounds great, D.
Okay.
It is interesting that companies, their first reaction, if they're worried about a recession, is first cut jobs and then cut their ad spending, right? I mean, it's like capital preservation. It becomes the biggest, what money in the bank, money on their balance sheet, becomes the biggest worry. And they, because people are a great resource, right? At a lot of these companies. Right. I mean, 2 years ago, you were talking about how you couldn't find an engineer. Now companies are firing engineers, right?
And I think it's obviously it's much harder to let go of a person than to let go of, potentially like just cut a cost that you could come back and get back fairly easy, right? You're not going to bring that. Maybe cutting back on advertising is much easier than, letting go of a person that you trained. It's more personal. So, but here, let's take a look at this. Here's Google, and by I love this is one of my favorite companies, but I'm just looking at it right now from just a fundamental basis, just to see what the numbers look like. And I'm going to show you guys. So, oops. Let's look at. So let's look at Google just from an approach of how they've been growing. And Google's one of, their revenue growth is pretty spectacular. It's been growing at a much faster clip, I think, than the rest of the market. And the question will be, well, what if Google's growth rate starts to get closer to the growth rate of the rest of the market, right? Hold on a second. I must have clicked on something that slowed me down here. I think it's my internet. Let me go to over here. All right, so here I'm on Google. Let's go to their summary here. So you could see here, just total revenue has been growing at a much faster clip than the S&P 500. And last year, 37%, rest of the market's 18%, even on a 5-year basis, 23% versus S&P 500, 7% on average. So you could see much faster than the rest, just on their revenue growth. And if you look at just taking the S&P 500, pretty much, the sales and marketing budgets grow proportionally with their revenue, right? So if you see 10% growth rate in revenue, you'll see 10% growth rate in the sales and marketing. So the question is, well, what if their revenue eventually just converges to that? So let's take a look at that from a fundamental perspective. Here's Google. We're going to compare, and we're going to use this comparative model. And this model, it's a simple calculator, okay, just to get a sense of, well, where do we think Google should be priced versus its market price, right? So we're going to come up with an implied value. And the implied value is basically looking at, earnings. And if we could project earnings, and if we could project, totally what, based on their earnings in the next 5 years, how much would they return on their enterprise value versus the rest of the market? Which one are you better off holding? And if they were equal, what is the implied value? So that's what the simple calculator is trying to do. And it takes a few assumptions here and says the following, that, well, what are the Google's operating profits, right? If they're going to generate revenue, what percentage of that revenue will become earnings to the shareholders, right? So sometimes, a company like Walmart generates a lot of sales and revenue, but at the end of the day, their profit margins are small. Amazon's are small, right? Because for every dollar in sales they generate, they might be only keeping 4 or 5 cents in profit. Google has higher profit margins. So for every dollar in sales that they generate in operating profit, last quarter they generated 30 cents in profit, right? So if we said that they will continue on that same path, and the S&P 500 continues on the same path of 15.5%, right? So that's our initial assumptions. So initially, we're going to create a base implied value, and then we'll create a bullish case and a bearish case. And then we say their revenue for next 5 years on average will be similar to the last 3 years, the revenue growth. So, if we take the revenue now, next year, they might grow their revenues, right? And then the following year, they might grow their revenues. And we have to come up with an assumption. What do we think they could grow it year over year? So if we take a simple projection of their last 3 years versus S&P 500, so the last 3 years, they were able to grow by 23.9% year over year, compared to the rest of the market, 7.4%. Right. So here we have these assumptions. I'm going to skip this volatility. If we use those assumptions, right? If we use those assumptions and we compare it to what it would cost us to buy up Google, right? Because if we buy Google, we take it over in cash. How much money would we return based on those assumptions in the next 5 years? So that would be a 56.7% return, right? So we're projecting profits, revenue growth. We're projecting profits per year, divided by the enterprise value. And then we're doing the same thing, S&P 500. And then we say, of course, what would be the implied value to equal those returns out, right? So then that's where we get the 149.24. So let's give it a bearish scenario, right? So if that's the case, then Google's undervalued 27.5%, because those assumptions say I'm better off in Google because as a shareholder, I'm going to have a larger return in earnings, right? I'm going to have more money coming in than the rest of the market. So that makes it a better deal. What if we change those assumptions? Let's give it a bearish scenario. Let's say that Google's operating margins fall back down to their 5-year average, 25.2. So that's 5% hit, right, on their operating margin. We're going to say that S&P 500 maintains on average 15.5%. But let's say this revenue growth, right, that this revenue growth, we're going to give it a bearish scenario, and let's just give it the same growth rate. It'll grow at the same rate as the rest of the market. So they'll continue to make higher margins, higher profit margins, but in a bearish scenario, we're going to say Google, Google's revenue growth will not outperform the rest of the market, but will start to converge because of competition, regulation, maybe maturing. So I'm going to change that assumption 7.4% to give it a bearish scenario, right? I'm going to recalculate that. Based on that assumption, the implied value is 78.39. So that would give it on the bearish case, it would be at a 38% premium. What did I say on the base case? It was like what was it, 23% discount? Is that right, Will?
Yeah, that seems right.
So let's give it now a more bullish scenario. Let's say that, let me see if I can, let's say, here, I'm going to go, let's look at their quarterly. So if we look at their gross, let's say we look at their operating margins, let's find one of their, so they have been, so 30% is so far looks like it is on a high end. Like we could see from 2020, that was a particularly, maybe bad year. Let's go back in history. So their operating margins have actually been improving. So they were in the high 20s, going back. All right. So I think 30% for now would be a pretty, given these circumstances, that looks like a bullish case for Google. Let me take a look at their growth rate. I mean, I think even the growth rate is pretty generous at, let's give it a 37% growth rate. All right. So I'm going to give it 30% gross margins. Let's give it a bullish case that it grows 37.4% year over year in the next 5 years. And the rest of the market continues on the same path it's been on. If I recalculate that, so you can see then it's at a almost 50% discount. So in this scenario, I'm giving it bullish, bearish, so you can kind of get a range of a base case, a bearish scenario, and a bullish scenario, right? I can't give you, there's no way to exactly say, because there's no way to exactly know how much Google or the rest of the market will earn next year, the following, or whatever. But we could play around with the numbers to draw bullish versus bearish or base cases. Right now, I would say, look, if we could give it 25 and a 23, just that reverts to its 5-year average. Maybe it's closer to fair value. So we'll see what Google says, right? We'll see how they guide us. We'll see what they tell us as far as their revenues go and what they're seeing going out into the future. So I guess, Will, what we covered, we saw Walmart issue guidance, earnings coming up in some of the bigger tech stocks coming up today. We took a look at Google, looked at some like a fundamental kind of approach to where the price could go based on a bearish scenario, bullish scenario. There are no questions. I guess I'll stop here.
Yeah, we got, looks like 4 minutes before the opening. Great job, D. Thanks so much for bringing this information on Google going into earnings. Pretty cool stuff. You have a great day, buddy.
Great. Thank you. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, comedians. Have a great day.